Let's go to stock picks. Grant, Nader, you're going with Steve Madden, which I was smart enough to know are shoes, but that's kind of where it ends. Tell me why Steve Madden is interesting.
It's an interesting company. It's fallen by more than 50% since the trade war, so for the year. But it's got a long track record of doing a great job, of executing well, of being very trend aware in their fashion, and successful. You know, they've pitched at a good price point. They're kind of in the Zara type of price range. So I think they've got a good niche. They've got a very strong brand awareness. They're growing well in SA. Out of interest, they did make a note to say that South Africa was their fastest growing region. I like the company. I think the entry point is really attractive. So it's been hit hard on the view that the majority of their production comes out of China. So there is that exposure. But these guys, and I speak for all of these companies, they have a way. The supply chains will diffuse to the rest of the world very quickly. They'll be in Vietnam or Mexico or wherever they need to be in a year from now. Most of this tariff issue will be resolved, or tariffs will be lower than what's currently being announced. And these kind of businesses will give you a real upside trajectory, some nice cyclical upside in terms of returns. So you're getting it at a really good entry point. It's a good business with a good brand, strong balance sheet, no debt. So I think it's an exciting opportunity if you fancy a bit of excitement in your portfolio.
Yeah, and some fancy shoes. I don't know any of those brands beyond the Steve Madden, but Graeme, you're keeping it nice and simple. 91.
Yeah, so just for context, 91 has got, 130 billion pounds of AUM, translates to about 3 trillion rand. That's a proper business, and it's been quite steady. They obviously lost some mandates when people obviously went to cash and others. But although we've been in a really difficult market, if you look, the FTSE is up. Most of the US indices are still up on a 1-year view. So for me, you're buying, I think, a really well-run business that's very, very geared to markets. You're getting call it an 8% dividend yield for your troubles. A little bit of movement in the equity market, if they were to achieve a couple of mandates, then suddenly this thing becomes, gives you really decent earnings growth. So for me, you're being compensated with a really attractive dividend yield. And of course, most of those assets actually sit outside of South Africa.
Yeah.
So it's a kind of a roundabout range play as well. So I think the bottom line is I like the geared market plays right now. They give you optionality, and you're being compensated even if the earnings don't grow over the next year. I think you're getting better than you're doing on cash.
Yeah, 8% is a chunky yield. That's all for Stockwatch today. Thanks to our guests, Graeme Körner from Körner Perspective, going with 91. Grant and Nader from Benguela Global Fund Managers, going with Steve Madden. Up next, to close, stay watching.